Dear clients, I'm Richard, Senior Phillip CFD dealer. Major US benchmarks continue to accumulate their losses going into 2015, with the tech-heavy Nasdaq 100 falling slightly more than its peers, namely the S&P 500, Dow Jones Industrial Average 30, and Russell 2000. Although all remain within mid-single-digit percentage of their all-time or multi-year highs, the question on investors' minds is whether US stocks are finally undergoing a long-awaited correction, or if it presents a buying opportunities that promises more gains ahead. To put things into perspective, US equity market is currently in its 6th year of the bull run, and it has been more than 3 years since the S&P 500 has dropped 10% or more. However, this month, this equity benchmark slid 3.4% from 8th of January till the 15th of January, posting its second slide of 5 consecutive days after going through all of 2014 without a losing streak of more than 3 days. And since its 29th December 2014 all-time high, it has fallen almost 5% through last Thursday's close. Furthermore, consider equity markets' dismal performance against the investment backdrop of increased global market turbulence, which underscored a key theme from my last commentary that cautioned investors to position for a volatile equity market heading into 2015. Indeed, investors' concerns are stacking up. From a weak start to US 4Q14 earnings season, apparently weighed down by a strong US dollar, coupled with a slowing global economy, confusion over the global dislocations of plunging energy prices, the Swiss shock that roils the FX market, to the World Bank lowering its global growth forecast for 2015, just to name a few potential risk-off headwinds currently undermining investors' risk appetite. With regards to the US earnings front, we have had aluminum giant Alcoa kicking off 4Q14 earnings season with an upbeat tone, but it was quickly overwhelmed by some major bank earnings releases that missed estimates. Subsequently, sentiment quickly sours amidst FactSet reporting that consensus estimates are for S&P 500 earnings to grow a meager 0.6% in the quarter from a year earlier, well down from the roughly 8% predicted just a few months ago. Last week's economic data was mixed as well, as it started on the back pedal given a surprisingly sharp and broad drop in December retail sales, which dampened hopes that US consumers would spend their gasoline savings elsewhere. This was somewhat contradicted later in the week by a rise in the University of Michigan Index of Consumer Sentiments to its highest level in 11 years, which may have helped the market end a negative week on a somewhat uptoned. Investors were also unsettled by huge price swings exhibited in cross-market actions. For instance, oil has collapsed by half in recent months, trading below $50 a barrel at around 6 years low, while copper, typically regarded as a global economic barometer because of its wide applications in construction and telecommunications, also tumbled 8% last week to a 5.5-year low. On the other hand, safe havens such as treasuries and gold rallied this year amidst the prospects for continued low global rate environment and given recent global market turbulence. Adding to uncertainty was last Thursday's decision by the Swiss National Bank to scrap its 3-year-old currency cap, which sends the Swiss franc soaring against the euro, as well as gained against virtually all other fiat currencies, and shares of Swiss exporters tumbled as a result. To sum up, recent global developments and the corresponding cross-market price actions, as illustrated above, are clearly exhibiting a volatile investment environment ahead. This assessment is in line with my last commentary, whereby clients have been cautioned for higher frequency of market setbacks and of course rebounds. As such, while waiting for more signs of market stabilizations and or global policy coordination to a view, it may be prudent for investors to consider de-risking their long market exposure into pockets of market strength. For the nimble and more aggressive traders, seeking out short opportunities may be a good risk-reward proposition amidst current market volatility and uncertainty. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. With that, I have come to the end of the presentations. Thank you for watching this week's Market Watch. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.